Welcome everyone to the Directed IRA webinar. This is Mat Sorensen, joined by the amazing, the fabulous, the great and powerful Aaron Halderman.
Oh, that was special.
Yeah. I've been waiting for someone to introduce me as the great and powerful because that's what Joe Rogan does to people he likes. I think he introduces him as the great and powerful, and
I think that's true.
It's kind of a good accolade, you know. But we're excited about today. We're going to be doing 6 ways to protect your IRA or 401k in a recession. So we got a lot of thoughts about this. This is not financial advice. These are self-directed accounts here, and we want you to do whatever the heck you want to do with your money. You're the captain of your own ship, but we got something to say. All right, I got some things to say today. Aaron's gonna, I think he's got something to say too. And we got a lot of your questions that we're going to be fielding along the way too. So we're excited for this topic.
Very timely.
Yeah.
Very timely with everything we have going on. So it'll be good. Put your questions over in the Q&A box so we can see that. We have some people here at Directed IRA as panelists will be able to answer some of your questions. I'll be monitoring that as well and tee up some good ones. So we appreciate your feedback. We won't get to all of them. We always get like 100+ questions. It would be impossible for us to get that done in about an hour, but we're going to go pretty deep and heavy into some subject matter here. Yeah. I think you'll be able to take away some actionable items and hopefully put them to use with the self-directed IRA or solo 401k.
Yeah, and these are the things our clients are asking, what some of our successful investors that have large accounts are doing. So we're going to talk through those things today. Also, keep in mind, this is going to be recorded. So, you got to have a bathroom break. You feel like you missed something. You got to run somewhere for whatever is going on. This is going to be recorded so you can catch it later. It'll go back on the Directed IRA website. Also the slides, we're going to be sharing some slides. Those will go on the website too once the recording's posted. So if you have any interest in the slides and want to grab those, you'll be able to get those at directedira.com at the webinar page. You can just find that in the Learn section on our homepage. So, all right, now let me go share some slides here because I got a disclaimer I want to give first. Aaron and I are going to be bouncing back and forth between having to look at our amazing faces. This is meant to be educational in nature today. It's not financial advice, not investment advice, not legal advice, even though I'm an attorney. This is educational. We're just trying to give you information and help you make better decisions on how to handle your money. These are the topics. You want to run through them, just give people a roadmap of what we're going to hit today before we actually hit it.
Yep. So we basically identified 6 topics that we wanted to cover. There are a few more, but I think, the mind can only handle so much. So like we're giving you our best hits here, the 6 best hits. So we're going to talk about, should you sell your account assets, when you can hold cash, analyzing whether to sell stocks or mutual funds, when it makes sense to do a Roth conversion. Does it make sense to do in this year in 2022? Assets that tend to perform well during a recession, based on what we've seen our clients do. I mean, we're privy to a lot of information as custodians, so we're seeing it firsthand. And then also we want to go over some like different alternative investments that can help with your portfolio diversification. So yeah, we're going to give you the 6 best hits.
Yeah. So we're going to be breaking those down here. And again, these slides are going to be shared on the side. I think some of them are pretty helpful, actually. Sometimes in the webinars, our slides are, they're more to lead us to what to go to. But I think these are some good notes and things to be thinking of. So come grab these slides if you agree. All right, I'm going to jump back into the slides. I think a lot of you are familiar with this. If you're on this webinar, we had, over 500 people registered for this. So some of you may be new. So let's just tell you a little bit about us as we get started here. So I'm Matt. This is Aaron, but this is a little bit about me. I wrote the book, the Self Directed IRA Handbook, featured right here. You can't see it, but when it comes back, I'm sharing the screen. I'm on the video showing you my book, realizing I'm sharing the slides so you can't see that. But it's been sold 35,000 copies. A lot of self-directed IRA custodians that are competitors use it to train their staff. The National Association in the industry uses it for certification training. I'm also a partner at KKOS Lawyers. I've been an attorney since 2006. 2004. This goes so fast. I host the Self-Directed IRA Summit, which Aaron helps produce for me, which is the 2-day, day-and-a-half event on just self-directed topics all day long, where we get in deep on those subjects. I also write for Entrepreneur Magazine. I'm a VIP contributor there. And also on my crypto side of my life, I contribute and have at Cryptopedia. So
that's a pretty big deal.
I'm kind of
Pretty big deal in the self-directed space. And I love it
like
here.
Ron Burgundy. I don't know if you know this, but I'm kind of a big deal.
I love it. So Aaron Halderman, I handle a lot of things over at Directed IRA. I've known Matt for a number of years. I've been in the real estate note space for over a decade. And that's how initially we came together. Matt would come and teach, the different audiences and clients and investors that I had in the real estate note space. He would educate on self-directing, the solo 401k, or the checkbook IRA LLC structure. And then when Matt decided to start a trust company and, go gangbusters, he gave me a call and I was like, he needed somebody to help do it with him and Mark. And I said, absolutely. So up and moved the family from San Diego to Phoenix, Arizona. And here we are just educating people on different things you can do with a self-directed retirement account. So my passion is, in all things like asset-based. So I love real estate, love startups, love note investing and lending, and then being able to use that with the retirement account is pretty powerful. So here we go.
All right. Should you ever sell assets in your account? Well, we want to be accumulating assets, of course. In our retirement account, we want to be growing and accumulating them. The one point I want to say on this, and some of these are going to go fast, some of these are going to take a little bit longer, and we are going to pop in for questions. There's a lot of questions in there already flying in. So we're going to be hitting that here in a second. Aaron will give some instructions. But the most important point I want to make right now is be careful of being too emotional right now. I've had a lot of calls with clients, even family members who've been invested in the stock market that's, had the biggest decline since 2008. Like during my lifetime, this is the second largest stock market correction. I'm 42. This is the second largest stock market correction ever. The only other time we've had a larger correction was in 0809 when we had the great financial crisis. And so 2022 has proven to be a challenging year for those retirement accounts. They're just wholly invested in the stock market. Now, our self-directed clients are like, well, what do we care? We've already been in real estate and private companies. We haven't seen that roller coaster ride where we got off of it, years ago. But if you've kind of gotten emotional, you've been down because you've seen your stock portfolio down, my one message is just don't make an emotional decision. We start making bad decisions when we make emotional decisions. And some people think it's their instincts. It's like, oh, my instincts are telling me to sell. That's your emotions sometimes. Be careful recognizing the two. And my message is on this point, be analytical. Now, let's say you've been in the stock market. Let's just address it. And your portfolio is down. You're down 20%, let's say. Your 100,000 account is now worth 80 grand and you're a little bummed about it. Went from a 3-figure account to a 2-figure account. Your 401k is now a 201k, So
that was a little commentary.
A little 401k.
Little color commentary.
401k didn't play that. But seriously, be analytical about it. If you're going to sell, what are you going to buy? Are you really going to just sit in cash? So if you're going to sell out, you need to be ready to invest into another asset. Now, maybe it is something like real estate or a note or a private fund or some other self-directed asset, but just be ready to have a plan and a decision. Don't just sell and be like, well, then I'll figure it out. Really? Be analytical about it. Don't just make emotional decisions that, might make you feel good for a second, but then all of a sudden the stock market rebounds and you've just been sitting in cash and you've missed the whole rebound too. So just be careful on that. Any comments on that? This is probably the fastest one. I just want to.
So yeah, a couple things. I forget which podcast I was listening to. It might have been an article I read. Anyways, the crux of it was, okay, well, the markets are down, right? And a lot of people's portfolios down 20, 30, even 40%, depending upon what they've been invested in.
Yeah, if you were like in tech stocks, your account's like down 40%.
So, but they did the base of the article drew the comparison of, okay, so let's say I sell, or I already sold. Should I be patient, to buy something or try and find a deal, like the buy low, sell high mentality, as it compares to the rate of inflation right now, which we're seeing, from what's been published, right? 8-9% nationwide. So okay, take that $100,000 retirement account, let's say, if it dropped 20, 30%, 10, 20, 30 grand, 20, 30% versus if I just set in cash, my buying power in the dollar, I might have lost like 8 grand.
Yeah.
So it's like, there's some argument there of like, okay, not to be so anxious to, have it be okay to be in cash and like wait for a good deal to happen as well. And we're seeing that a lot too in people's retirement accounts with us. They're like, I'm just waiting for a good deal. Yeah, that's totally cool.
Okay, now you're already on the second point here. This is a perfect transition to it because that's what I want to talk about. Because this is really the debate right now you should be thinking about with your retirement account and your investments. And both of these can be right. Do you believe that cash is king or cash is trash? Okay, there's two schools of thought out there right now. Some people are like, cash is king, man. Mm-hmm. Cash is king. Now, if you believe that, the only way you're going to make money on that cash is eventually you got to buy an asset, right? Well, cash is king only if I'm kind of this vulture type mentality where I'm seeing these awesome deals, I'm seeing these awesome values. We're in this recession, environment, and there's opportunities now where I can buy stuff. And this was a lot of clients with our self-directed accounts, my clients, that before we even had directed back in 08, 09, they were like vultures. They came in and they got bargains on stuff. It was insane the type of stuff they were picking up on foreclosure properties and short sales and all those opportunities in the real estate market. And they were kind of vultures, but it took cash. You had to have cash. They were doing hard money loans at 15% and 3 points, which you can't do that now. But people were like, I'll take it because that person had a deal that they could have huge returns on. So that's the first mindset, is cash is king. But you got to have, I think the only way you make money on that is if you've got this kind of, I hate to say it, but vulture mentality where you're going to come in and pick up that stuff that, where there's bargains and low prices.
And also investing in what you know, right?
Yeah,
I mean, that's a big thing, because sometimes people are like, okay, well, I don't know much about real estate, but I know more on like lending, or I know more on like the next, big startup that's going to hit, because I love to research and I want to do that too. And so, but those all take cash still.
Yeah. And so on the other hand, and this is kind of me right now, is, this is personal, Matt, what do I know? Is cash is trash. That's more my mentality right now. Cash is the worst thing you want to hold when there's inflation. Okay. Your purchasing power on that is decreasing, right? Now, again, I get the vulture mentality and cash is king because I can go buy assets at bargain. And I know there's people waiting out there who are just like, hey, I know that there's the proverbial shiz has not hit the fan yet entirely, and I'm going to find deals out there in the private investment market. Okay, I've seen it before. Trust me, I get that. But right now, you'd rather have assets, right? When there's inflation, particularly real estate, even a lot of private companies, like these assets are appreciating in value when we have inflation. And so you'd rather be holding assets that increases in value with inflation rather than cash, which the purchasing power decreases of it when you have inflation. So, so analyze this for your situation, and you got to make your determination for you. Are you holding cash? If you're holding cash, what are you doing with it? Presumably you're waiting for that opportunity to go monetize it, find the deal where you're going to make money.
I love it.
Okay. You want to take any questions yet, or you want to just come back to them?
We'll come back to them, but let me just add one last thing on that. Now is a great time to be educating yourself on other investment types too.
Yeah.
Like while things are, sorting themselves out economically. Obviously some stocks, mutual funds, even the S&P 500 is, not performing like it has been, the past 10 years, like just going gangbusters. Like now is a great time. There's a lot of great educators out there that you can go find, kind of pick the investment that you're interested in and start going through their course material. Like there's so much information out there that you can just study on your own at home without having to go to an in-person seminar. Like just go through it.
Yeah. You want to be ready so you don't have to get ready.
Yes.
Yeah.
Yes.
Hone, my friend Honey's a client here. I stole that line from him. I just want to give you credit for that. These, self-directs account, great guide, but I always love that because it applies to self-directing is sometimes you're going to have an opportunity come along.
Yeah.
And if you're not ready, that opportunity is gone next week. You don't have a week to get up to speed on how to use to buy real estate in an IRA. And that deal's toast by now. If it was a good one, it's going fast. So you got to be ready. So you don't have to get ready.
I love it.
All right. Okay.
And that goes for getting your accounts ready, right? Or structures you're going to do.
Right. Yeah.
Like the same thing applies there. If you're like, hey, I want to use my retirement account, I want to do a real estate deal, or I want to do some hard money lending, or I want to go buy a multifamily, or a 4-unit or whatever it is, like you got to have your structure in your retirement account set up in order to do that. So, and they got to be funded or at least partially funded.
Do you call it a 4-unit? I think a lot of people call it a 4-plex. That's what
I call it.
I
don't know if that's the Texan in me or what that is, but I like a 4-unit, a 2-unit, or a 4-unit. I don't know, 4-plex, a 2-plex. Now we do call it a duplex.
Yeah.
Now
it's not a duplex, it's a duplex.
It's a duplex.
Emphasis on the du.
We lived in a duplex when I was little in San Antonio.
Awesome.
4-unit.
Okay. All right. Next thing we want to hit on. Sorry. I want to just talk about whether to sell stocks or mutual funds right now, or really any assets in your retirement account. A common question usually comes up when you're in a recession like this, or values are down. And again, we've had these historic market lows. Well, some people in their personal account are like, hey, I'm selling and doing this tax loss harvesting. I'm getting these tax losses in my personal name that I can use to offset other gains I might have in future or other income. Okay, but that doesn't work in your retirement account. So don't feel like you need to sell an asset to lock in a loss in your retirement account. There's no such thing as that. Retirement accounts don't take losses. Just like there's no gains when you make money in a retirement account, you don't get to take a loss when values go down. So don't be chasing that or thinking that. I had a customer a couple weeks ago thinking they were going to get that. And I had to break it to him, sorry, and this was a heavily tech investor client. This is why it's like when you're like 20, 30, 40%, this client was heavily invested in tech stocks in the stock market, which have had probably the biggest corrections, and was selling in his personal name and thought he'd get the same treatment in his retirement account. He was a little bummed out, let's just say, a little bummed out by my news.
Yeah.
Okay. Now with that, on market lows though, there are some things you can be thinking about with your retirement account. Like the first thing I thought about in all of this is Roth conversion, right? Like, the best way to do it is like, you'll never get a better deal to convert to Roth than right now. Right? Yeah. And I want to give 2 reasons for that, 2 critical reasons. One, again, if you've been investing in the stock market or your account's seen, again, a lot of our self-directed clients with real estate are, Matt, my account's up. Okay, but I'm just hear me out. I know a lot of you are also in the stock market, or many of you have not self-directed yet. Converting to Roth is an awesome strategy. When you have traditional dollars in your retirement account, right, you're growing that. And when you hit retirement age of 59 and a half, you can start pulling it out. But as you pull money out, you pay tax as you start pulling it out. Well, in a Roth account, I'm building all that money up. And when I start pulling money out when I'm 59 and a half, I'm retirement age, there's no tax. I don't pay any tax. It's totally tax-free. But to go from a traditional account to a Roth account, the IRS lets you do it. You just have to pay tax now on the value you convert now. So let's say you got a $100,000 account, traditional account. You're like, I'd rather that be 100,000 Roth IRA or Roth 401k versus traditional IRA, traditional 401k. To convert to Roth, we have to take the value of the account now. Let's say it's 100,000, and you're going to get a 1099-R from us if we're your custodian or whoever your IRA custodian is. That 1099-R is going to say 100,000 of income to Mat Sorensen. Let's say I'm doing this. I'm gonna have to put that on my 1040 on my personal tax return, and it's 100,000 of income. If I'm in a 33% tax bracket, or let's say 40% between Fed and state, I'm paying 40 grand in tax to do that. Now, that sucks, right? People are like, I don't want to do that. Okay, but think about this. That 100,000 later goes to 500,000 by the time you retire, and it's going to come out tax-free at retirement entirely. Now I'm paying zero tax instead of paying tax on 500 grand on the way out. So you've taken a hit now. There's some pain in it, of course, to pay that tax to convert. But the beauty of it is it can grow as much as you can, and it's going to come out entirely tax-free. All right, so now it's the Roth conversion. Now, why I'm saying it's such an awesome idea now is really two reasons. One is if you've been in the stock market, your value is lower. So you have the same assets you had, but maybe that 100,000 account's only a $75,000 account. So you're only going to pay the Roth conversion on 75,000 of value instead of 100,000. Okay, that's awesome. I got a smaller value. It's going to be a less tax burden to get my account over to Roth. Okay, so that's point number one. Point number two is if you're a high income earner, Congress has been really trying to shut down the Roth IRA, particularly the Democrats in Congress. They think it's a tax strategy exploited by the wealthy, and Peter Thiel having his $6 billion Roth IRA didn't help that. But so they were trying to shut out wealthy people, 200 grand or more approximately, which, you know, that income, from being able to convert to Roth. So, so it could happen. There's nothing impending right now. The bills that have had it have all failed, but there's this talk about it still and shutting it out for Roth. So this might be a good year, still viable to convert to Roth for even high income earners. So that might be a good time to convert to Roth for those two reasons.
Yeah. So we got a couple questions that came in on that. You know, hey, I am a high income earner, 300 to 400K, 500K. I'm in my late 60s. You know, would it not cost too much in the high taxes to do this? Again, it goes back to, you know, you ever heard the saying, you want to pay tax on the seed or tax on the gain? That's exactly like what we're talking about with this type strategy. Sure, it's going to be a little bit of a punch in the gut, you know, to get it done. Another thing though, that's cool that actually Matt's written an article on, and I think there's probably a couple podcasts out there too, is like, don't just do it this year. You could do what's called the chunking method.
Yeah.
And two, which is a cool strategy that you could do it over a certain period of years. And that takes a little bit more creative planning with your CPA, especially for you higher income earners. Yeah. Like look at doing that. So maybe it's 100K you're looking to convert. Maybe you're doing a third of it over the next 3 years or so.
Yeah. So how old was he? Late
67. 60s? Okay. Yeah, 67.
So
he makes 400 grand.
Okay. All right. So many considerations on this, because what I would want to analyze here is, are you going to still be making that 400 grand a year approximately in retirement? Because if you are, you're going to still be in a high tax bracket then, which means that you're pulling money out of your 401k, you're going to be paying tax. Now I get it. You're paying it later. But if you're like, no, that's my salary, I'm a high wage earner, I'm not going to be getting that. But if you're like, no, it's all my investment income, I got a ton of properties and all this, which is a lot of our clients. A lot of our clients are like, guys, my financial advisors and all the financial advice is you're going to make less money when you're retired. So don't worry, you'll be in a lower tax bracket. And a lot of our clients are like, I don't want to be making less money when I'm retired. I'm trying to build assets that create money so I don't have to work. And that's
don't worry, it's going to be cut in half in your retirement.
Don't worry, you won't be making money in retirement. Like, dang it, that's not what I was hoping for. But everybody's a little different. So I don't know your situation, but if you are like, no, I'm a high income earner, I'm going to like pretty much Social Security once I retire, then I get it. Then you might be fine just paying on the way out. Now, if you were 47 or 57, I would be like, I'd still convert to Roth. You've got, 30 years approximately to be building that account still to have it come out totally tax-free in Roth. At 67, the time of that to double it or triple it might be a little harder. Maybe you got another 20 years to do that. I don't know. The IRS thinks you're going to die when you're like 85, which is, that's in the IRS tables. That's for, I don't know, women, they think they're going to live a little longer, but anyways, so I just want to analyze a couple of those factors to determine whether to convert. And like Aaron said, another good idea is just break it up. Some clients will break it up into multiple years. I like just kind of getting it done in two, because like right now,
rip the Band-Aid off.
Yeah, you could convert half right now, and then on January 1st, 2023, just convert the other half. Just get it done. And then that is broken up over 2 tax years, so you get you're spreading that tax liability over 2 years.
Well, you did. The follow-up on that was this particular question that came in that there was 67. He is retired.
Oh,
That's what he's making. He's doing hard money lending, which is beautiful in a retirement account too, like getting some of that over. So now it makes more sense. Like I want to do some hard money lending in my Roth.
Yeah. Yeah.
So that's what he's doing as a hard money lender.
So, I mean, that's tough because you're a tough one because on a traditional account, you're still going to be in a high tax bracket pulling that money out. So it's 67. I don't know. It's a tough call. I would, if you think you can get good returns, and if you're a hard money lender and already know how to do it, you're making 400 grand a year personally, you probably be able to do the same in your Roth IRA.
Yep.
And again, maybe you got 20 years. That's again what the IRS thinks. I don't know.
You could be a centurion.
Yeah.
Right. And they'll call it 100 when you hit 100, a centurion.
Yeah.
I
think so.
Yeah, I think so.
I just know there's like an
I feel like we need our own young Jamie or a fact checker.
Yeah, we need a fact checker because,
I'll throw some stuff out there.
Okay. All right, let's get to, we're a couple slides behind. Sorry, I'm going to share some of these just for a moment. So one thing I did notice in 0809, just because I was handling clients back then, is we saw a record boom in clients that wanted to self-direct after that last 0809 crash, because a lot of people lost faith in the stock market and were like, oh my gosh, I can't entirely be invested in the stock market.
Sure.
And so we're going to talk about that here in a moment, of course. So it created a huge wave of self-directed investors after that. And a lot of the smart ones converted to Roth. Okay, let's talk about assets that perform well during a recession. Now, I went and looked at some of these in general, and these are generic little, things. I kind of looked at precious metals, and we've been told about gold, it performs well during a recession. I don't know, look at it over the last year. It's been pretty flat. All right, and the price of gold, like the per ounce. Crypto, a lot of people are told, hey, if the Fed, the government's printing money and we're in a recession, everyone's going to flock to crypto. The opposite's happened. Crypto is actually down. There's tons of reasons for that, but who really knows, quite honestly, but that didn't hold to be true. People thought it was going to be the new gold, so to speak. And maybe crypto and gold are competing with each other now, as like the old gold and the new gold. People are trying to get to hard assets, but whatever. Crypto, we know, is all down. Real estate's still been up, and interest rates continue to rise. Now, real estate, there's not a real estate market. There's many real estate markets. This is all, real estate's super local, so it's hard to say. But real estate still overall has been up, tried and true. Also, for those that have rental properties, it creates cash flow, which was, you have inflation. And this is just, I have rental properties in my retirement account, and I got awesome appreciation in them. And I just raised my rents. Like literally, I just renewed the lease 3 or 4 weeks ago on one of my properties. It's in my retirement account, and I increased the rent like 15%. And the tenant was totally fine with it. Same tenant was there before. And that's just what's happening across the market, is you're able to increase rents. Of course, we all know stock market has been down. So that's kind of the general scope of what's happening. And, we're kind of, are we in a recession yet or not? There's still debate on that, but we're super close. We're certainly at least in a recession environment, quote unquote. So what we like to do with clients, and what we want you to be thinking about as you're thinking of self-directing, is I really like to think about just portfolio diversification. And when we had 0809 hit, and I just remember all the clients back coming out after 0809, people were like terrified of the stock market, and the economy, and they wanted real assets. They're seeing stuff on their computer screen and statements that come in the mail of XYZ fund. They don't even know what the heck it is. It's someplace on Wall Street. And it just seems so intangible. And it was really hard with people understanding, man, this is my money and I've saved in this thing for decades. And this 401k is a 201k now, whatever. And so there's this push really to alternative assets as a way to diversify. And maybe you go all in on self-directing. Maybe you're just taking a piece of it to have this quote unquote diversification. And we think a good balance between the two is great. But sometimes your financial advisor will be like, well, we should get some real estate in your portfolio. And they just buy like a REIT on the public stock exchange, which that is not really diversification. So just know, of course, you can literally own the duplex down the street with your retirement account. You can literally own like a piece of a multifamily property.
That 4-unit.
Yeah, you can own a 4-unit, even a 4-unit. Absolutely.
Real estate's an interesting thing though, because it's like, look at it's just been going up, up, up. But then there's always deals though. So there's always deals because it is so localized too. Like you can always find something where somebody has some sort of hardship or something going on to like find a deal. Or in your case, like, people aren't buying as much, they're wanting to rent. There's you know more of a renter's market. So then you raise rents and then you're getting better returns in your retirement account that way. Like, so it is a real, I don't want to like say it's recession proof, but there's so many like different creative ways you can do with it that in a lot of ways it is because you have something that's always going to go through a cycle and rebound. And the same thing goes for lending. Just like there's always people needing a place to live, there's always people that need to borrow money to fix and flip a project or to go invest in that for you or whatever it is. Like those are like two solid diversification plays right there that I love personally. Like that's how I even found out about it. Like about self-directing in the first place. It's like, oh my gosh, you can do it on a real property in your backyard. Like, it's the easiest thing to do.
Yeah. And one of the things that's interesting, there's so much supply and demand analysis in this. And if you look at real estate, and these are just the stats I've just been looking at, is, I mean, there's a limited inventory of real estate, right? Yeah. You have a growing population, a lot of millennials finally moving out or wanting to buy. And so we've seen like this huge demand for real estate, and the builders aren't keeping up with the supply. You can look at the housing starts and properties in construction. They're not up to pace with what people think the housing demand is. So the supply is limited. Well, that means price goes up, rents go up. That's just how this works. Now in the stock market, one thing that's interesting on just this supply and demand, by the way, I do have a bachelor's degree in economics, it's been pretty worthless, except, right now, but no, I actually thought it was a great undergraduate degree. But so anyways, in the stock market, one of the things that really drove the stock market recently, and this was Goldman Sachs did a report on this, was retail investors. There was a huge percentage of retail investors. These are like people on their Robinhood app. They're not the Wall Street crowd. They're not the high net worth crowd. It's just the average everyday person that's just like starting to trade in the stock market. New people, new entrants. They get this retail investor name. But they were driving like 30 to 40% of stock purchases, which was like a huge change where it used to be like 10 to 20 was kind of the retail investor. And so that huge surge in just buys was more buyers are in the market for all these publicly traded stocks. But what happened when the market started going down is they're the most finicky bunch too. They got scared and flooded to cash. And what's the other stat that was super interesting on this is cash in bank accounts is at an all-time high. The average deposit in personal bank accounts right now is at an all-time high because people have gotten out of the stock market primarily. They've been freaked out. And they were using all this cash they had, more money, more income, stimulus money, all the stuff that's coming through the economy to go buy stock. And now they've sold and flooded back to cash. Well, so that's kind of just a little thing that's been happening in the stock market. What the heck you do with that information, I don't know. But I just thought it was a super interesting stat that tells the story of what's happened and why the stock market's gone down. So maybe that's a piece of it, but I just thought it was an interesting stat.
I think it's the whole crux of like why our industry even exists is when we go through these different economic cycles of uncertainty and down markets are like, hey, like what's precious to me is my retirement account. And I just saw it go from a 401k to a 201k. And what can I do to like diversify or take control, right, of my retirement and what I'm investing in. And that's why we love what we do to educate other people on the opportunities that are out there. And it requires some due diligence and some, education on your part, but that's why we do all the content creation on a weekly basis. To like get that out for you. So, I mean, it's what we love and what we recommend you do.
So let's get into this. We just spoke a moment ago about be ready so you don't have to get ready. And with that comes learning the different investment types of what you can do with your account. You can go to directedira.com, hit our learn page. This is where it's going to take you. It looks like this. And these are a lot of the common assets that people are investing with the self-directed account. And we have clients have success and failure in all these categories.
Sure.
Okay. So even real estate, you can say, well, real estate's up. There's still people that can lose money on real estate. Okay. Even in the market going up. There's people making money in the stock market right now, even when it's going down. Okay. So you can't just make a generalization about this. And in many ways, it's having the right strategy within that investment class that is what pays off. So like real estate, for example, what's your strategy in real estate? You know, if you were looking back to 08, 09, what people were doing that was successful is like they learned how to do short sales.
Yeah.
Okay. They learned how to buy foreclosure property. All right. They were getting properties at bargain prices. They were buying low, and then they were later coming and selling high and making money, of course. So, so you want to figure out the right strategies too within these asset classes. But and so many of you guys are, I think, experienced in what you do. You know, you might be super experienced in private lending. You know, like that client on hard money lending asking about that question.
That's a full-time living.
Yeah.
Like more than a full-time for a lot of people.
If you're making that on private money lending, you know what you're doing. And maybe you should be doing that in your retirement account. You know, that type of return in a retirement account where you're paying no tax and that money just keeps rolling and building and building and building. I mean, that's powerful. Those types of returns you could get are pretty phenomenal and would certainly beat the stock market.
So there are some of you that are newer, so we'll just talk about that real quick. Like, what is private money lending or hard money lending that falls in there? And a lot of people use what's called a checkbook IRA LLC structure, or they'll use their solo 401k. But you know, you probably have had a buddy or, you know, a family member that's done a fix and flip on a property. And typically what happens is they're basically looking for two things. One, hey, do you want to partner with me on the deal?
Yeah.
Okay. I got so much money. I'm looking for a 50-50 partner. You help lend some money. I'll put some down and I'm going to do all the work. And like, we'll share it. Well, there's a, you know, a deed of trust and a note that are part of that transaction. I'm not going to go into all that, but you know, when you buy your own house, you have a promise to pay the mortgage company that you borrowed money from. That's your note. And the deed of trust is the actual security instrument that gives you ownership, right? So those are the two components there. Yep. So those are the two components. So what you can do as an investor, when somebody's like, hey, I want to go do a deal and fix and flip, or I want to turn it into a rental property, I need to borrow some money or borrow the money to do the rehab portion, you can come and use your self-directed IRA to do a private money loan.
Yeah. So let's just, we're just spitballing here. Okay. Let's say you believe, and I don't know this, I'm just saying, you gotta have a thesis here about what to do. But let's say you believe that the real estate market's going to have a correction.
Sure.
Okay. What's going to happen in that market? There's going to be two people making money in the real estate market. Real estate investors who know how to buy properties at discount, short seller foreclosures, which you can do with an IRA, by the way, or a 401k, you know. Also, people lending to other real estate investors. Okay. Again, I go back to 08, 09. We had a lot of clients using their retirement accounts to buy properties and make a profit by then selling them later or turning them into rentals. And we also had clients lending money to other people who are doing the deals because they're like, I don't want to be the guy going and finding the deal and
or doing any of the work,
fixing it up, dealing with a contractor, you know, kicking the tenants out, giving them cash for keys because they won't get out, whatever you got to do. You know, I don't want to be that guy. I just want to be the bank. I want to loan money, get 10%, 12%, whatever I can get some points on it. And that cash is going to become more valuable, of course, when the market goes down because people are a little more nervous about that. Banks start lending less on that type of stuff. So, but that goes into you need to be ready because when that shift happens or wherever you think the market's going, you need to be ready with that strategy. And then, of course, knowing that you can use the retirement account to execute on that. Now, the one thing on promissory notes is you can't lend yourself money. So if you got your retirement account, you can't be like, well, I'm going to loan myself money to do a deal personally. That doesn't work. You got to loan to other non-related people.
Mhm.
You can't loan to your spouse, your parents, your kids. These are all privilege transaction rules. We have a lot of content on that podcast and such, but
brother, sister, uncle, aunt, that was all good to go.
Yep.
The other thing too on real estate, because we get this a lot, and that question just came in. Hey, I want to get my rental properties into my Roth. How do I do that? Well, bad news, like you can't.
Yeah.
Like you personally own those, so you're not getting those into your retirement account. The other question that came in, and this is a common one as well, and I think sometimes you just need a refresher. Hey, I want to get more money into my Roth, but I can only do a new contribution of $6,000 or $7,000, depending upon your age. How do I get more money into that? Well, the answer to that is you probably have an old employer plan or old 401k, from previous jobs you've held, and that you can roll over into a retirement account and do a Roth conversion that way as well. Yeah. So we had multiple questions coming in that. So I just wanted to make sure we checked the box on those.
Okay, let me hit some of these other investment types and then we'll do questions. If you want to grab some good ones.
Yep.
Real estate. There's a lot of opportunities in real estate. You can be doing fix and flips. This could be rentals. The IRA LLC is, of course, a common strategy.
Mm-hmm.
Rather than your IRA owning the real estate, your IRA owns an LLC 100% that you can manage. The LLC in turn owns the property. So these are common assets. Again, we have more content on this. We have a quick start guide on real estate. It's about 5 to 6 pages. It's kind of like the down and dirty of what you need to know to invest in real estate with an IRA. It's actually a really good quick summary with some diagrams and charts that lays it out fast on what you need to know. You can get into private funds and companies. This is our second most common asset that people will buy with a self-directed IRA. So real estate is number one, and a lot of those come through an IRA LLC rather than real estate directly. But the second most popular asset is just a private fund. This could be anybody's private fund. They're out raising money on a bigger real estate deal, commercial property, multifamily property, or maybe it's an investment strategy type thing on single family where they're buying lots of properties. But your IRA could be buying 1%, of the fund or something for $100,000 or whatever, or $50,000. Usually those have a $50,000 minimum investment. There's some of them that have lower ones. I won't drop any names here, but there's some other ones out there that you can get into for less. But these are just ones you might find just someone in a real estate group you're a part of. You might find in real estate networking groups, there's someone that operates and raises money for deals. You want to, of course, do your due diligence, but your IRA can invest in those. Your retirement accounts can invest in private funds doing bigger real estate deals. If you're like, guys, I'm not interested in, I like real estate, but I don't want to do the 4-unit, property, or I don't want to do the single family rental down the street. Go invest in a fund of someone else who's doing kind of bigger real estate deals where you're getting a piece of that action as a partner in the deal, putting in cash from your IRA.
Ooh.
Okay, you want to hit some questions?
Yeah, because we do get this a lot. So as a real estate pro, why would I put property in an IRA and lose the depreciation benefit?
Okay, so for a couple reasons. So a lot of people will say, I don't want to self-direct and do real estate because I want to own real estate in my personal name because I get the losses. And okay, cool. If you're a real estate professional in particular, you can take the losses from your rental real estate in your personal name. Let's say you have an LLC that you personally own that's got some rentals. You can take those losses and offset your day job. Maybe you're a real estate broker or something. That's a real estate professional. You can use your losses on rental real estate to offset your other income, which is a huge tax burden. Now, only real estate professionals can pull over unlimited amounts of losses to do that. Everyone else, your losses kind of get bottled up here, and you can use them against other properties, but a lot of times you're just getting bottled up over here. Like me, I can't use my losses on my rental real estate I own personally. I can use them against other rental properties over here, which I do, that have gains and cash flow after depreciation. So that's a big knock that people have. But I have 2 important points on that, why I'm not a believer in that at all. The first is retirement accounts don't pay tax, and particularly a Roth account. So who cares about losses? Would you rather not pay tax? When you sell that property in your personal name, you're going to pay tax. So you have to think of the trade-offs. if retirement accounts don't pay tax, why would the IRS let you take losses? So when they said, okay, we'll let you not pay tax when you make money on this, the rental income, the gain when you sell it, no tax. Okay, and when it's a Roth account, remember, no tax on the way out. Well, a rental property, personally, we'll let you take losses if you have losses on the property after all your expenses, including depreciation. Cool. I love that in my personal name. But we're going to make you pay tax when you sell it and make money on it. You got me. And we're going to make you recapture all that depreciation you took also when you sell it, which you have to recapture that depreciation you got tax losses on and the benefit of it. So eventually it comes back to hit you. So now, again, I still love it. I love that in your personal name, but I think the retirement account actually has a better deal. I'd rather have no tax at all than get to take tax losses, have to recapture depreciation, and pay tax when I sell the property. So that's point number one. Point number two, I used to speak, and I'll probably get back to it. I used to speak to a lot of real estate agents. I go to the real estate associations across California, Arizona, Utah. I've been all over at them. And many times I would go there. These are all real estate professionals. Many of them own rental properties in their personal name. And I ask them, how many of you have a retirement account? Half the room's hand goes up. How many of you are invested in a mutual fund or stock? Everyone's hand is up. How many of you buy real estate with your retirement account? No one's hands up. How many of you think you could do better with real estate investments than mutual funds? Everybody's hand goes up. I'm like, what's wrong here? You feel like you can perform better, find better deals, make better investments in real estate, grow your account bigger, but you're buying mutual funds with your retirement account. Why are you doing that? Well, because it's easy. You clicked a few buttons, you didn't have to do much work, and it's just the money you got.
And I get my depreciation.
Yeah, well, yeah, but that the mutual funds and stocks, you don't get that. So, I mean, your personal real estate, sure, but what I'm just saying is, look at the total rate of return.
There you go.
If you believe the total rate of return is better, you're going to make more money, grow the account larger using real estate as the investment asset than a mutual fund. And why are you buying mutual funds? Now, not everyone can do that. Okay. Self-directing is not for everybody. If you know nothing about real estate, well, you got to learn something. Otherwise, you're going to lose your money. Okay. But if you happen to be a real estate professional, like the question, whoever came with that question, you probably know something about real estate, probably better than what you know about mutual funds. If your retirement account's just invested in mutual funds, what are you doing? You're like LeBron James betting money on playing ping pong. Go play basketball. Go win some money, make more money, and do what you're good at. You'll get more returns, total returns. Okay, got in a soapbox on that one.
That was good. Remember, you have to recapture. So Matt just answered that on the depreciation. So that came in on the other side of the coin. Yes, you're correct. That is how it works.
Yeah, you have to recapture your depreciation. When you're taking that personally, it comes back where you have to recapture it when you sell the property. Now you can 1031 it, of course, into the next deal, and but you got to meet all those timing rules, of course, with the 1031. Okay. What other questions you want to do?
We could hit on, well, let's hit on it because it does apply for UDFI.
Okay.
And what that is. What is it? How you calculate it when you sell a property with the self-directed IRA? Okay.
UDFI stands for unrelated debt financed income. This is a version of UBIT or UBTI, but it's considered a separate tax, UDFI. There's a chapter in my book on it here, Self Directed IRA Handbook, which is $20, by the way. You can get on my website, matsorensen.com or Amazon. But UDFI, the best way to understand it is an example. I'll give you the definition here, but if I lose you on the definition, trust me, the example will make sense.
Okay.
UDFI is a tax that applies to the debt, to profits your IRA receives from debt. Okay, it's kind of confusing. Let's take an example. Let's say your IRA buys a property for 100 grand. Okay. And let's say your IRA puts 40,000 down.
And I borrow 60.
And you'll borrow 60.
Okay.
Okay. Now that's 60 when you get a loan, which you can do that. IRAs can get loans to buy properties. It has to be a non-recourse loan. You can't just go get a regular mortgage from a bank. There's banks that specialize in lending to IRAs.
Which is cool because there's no personal guarantee. It's the retirement account that's guaranteeing that non-recourse loan. That's cool.
Yep. And all they can do is foreclose and take the asset back.
Yep.
So that's what a non-recourse loan is. We have a webinar on that 3 webinars ago where we went
Yep.
into that. And I think we even got into UDFI.
We did.
So, but let me answer this question. So bought a property for 100 grand total. 40,000 was the IRA's cash, 60,000 was debt. Let's say you sell the property a year later. Let's say you sell it for 110 grand. But let's say you sell it for 120. You have 10,000 of expenses, and at the end of the day, you got 10,000 of profit.
I like that.
Okay. To the IRS, they look at that and they say, all right, when you bought that property, 60% of that was not retirement plan money.
Mm-hmm.
So we're going to let the profits go back in the retirement account, but you got to pay tax on that because that was non-retirement plan funds. The other 40% of the deal, the 40,000 you put in,
Mm-hmm.
that was retirement plan money.
Easy peasy.
You don't have to pay tax on profits you make from that. So what they do is they make you apportion the income. So if you had 10,000 of income and 60,000 of that is attributable to the debt, here 60%, okay, 60% of 10,000 is 6. They're going to make you pay tax on 6 grand here. Now that's the taxable income. Now the rate, you get capital gains rate on this on the self property, which is 20% max. So now we're at $1,200. So I was able to leverage a $40,000 retirement account to get a $100,000 property. I made $10,000 and ended up having to pay $1,200 in tax.
That's a pretty dang good deal.
Yeah, which is a pretty good deal at the end of the day. That's like a little over 10% on the gain of what you're paying in tax.
And no partners.
And that was leveraged 60%.
Mm-hmm.
Okay. And now if you think about it this way, let's think about it another way, that same deal. Let's say this was Aaron and I. Let's say I used my IRA and I put in 40 grand and I got 40% of an LLC. Let's say Aaron just put in personal cash for 60K. We went and bought that same property. The IRS is going to do the same thing. When $10,000 is made, they're going to say 4,000 goes to Matt's IRA, no tax. That's what happens here if I just got debt too. The other 6,000, that wasn't retirement plan debt,
Mm-hmm.
or that wasn't retirement plan money. We're going to charge tax on that. Now, in the example with Aaron and I, he's going to get that money after he pays the tax. When UDFI, your retirement account still gets the profits. It's just got to pay the tax. So that's how it works in IRAs. Now, 401ks and solo 401ks are exempt from UDFI on leveraged real estate only. Okay. Other assets you may be buying with debt, this does not apply. Other versions of UBTI, like flipping properties and stuff, this doesn't apply to. So just keep in mind, there's an exemption for solo 401ks, which again, we have more content on that. Check out the webinar on solo 401ks where we go into it.
Exempt from UDFI, that's for having a solo cave structure, not UBIT.
Yeah. And sorry, these answers seem long to me. I don't know why, but
it's like, there's a lot to it.
There's a lot to it. And I'm,
I want to be thorough.
I've got these habits as being an attorney for the last 18 years where, I bill by the hour. So I make answers go long.
You'd rather have the whole truth.
That was a joke.
Whole truth, not partial truths. Like talking to my children. I'm like, well, I just chose not to tell you that.
Yeah.
I'm like, well, that wasn't like the whole truth.
Yeah.
Like you left those 3 other key pieces of information out.
Yeah.
Like that I needed to know.
Yeah.
So anyways, we're trying to take care of that. Okay, let me see what else we have. I don't know what you said. Can I buy and collect rental income in a Roth? Wait, where'd it go? Somebody just answered it. Okay, never mind. One of our panelists just took it. Okay, are there limits to buying real estate and collecting rental income in a retirement account? Do the same rules apply regarding the type of retirement account, such as a traditional or a Roth IRA?
Yeah, so buying and collecting income in a rental property, the same rules apply to a traditional IRA, Roth IRA, solo 401k. I mean, like the retirement account needs to receive the rental income. You can't receive it personally. It's going to pay any expenses on the property. And of course, it's going to have cash flow appreciating.
Mm-hmm.
I'm not sure I understand the full question on that one.
Well, so sometimes people are, the first part of it is like, are there limits to how much I can buy or, what I can collect?
I mean, only is how much what you can do,
account.
Like if you got 100 grand in your retirement account, well, I could buy a property for 100 grand of cash.
Mm-hmm.
I could maybe buy a property with 40 grand of cash, another $100,000 property with 60,000 of debt, or I could do creative deals. I mean, a lot of our clients are real estate investors doing creative deals personally. You can do the same thing, do a creative financing or acquisition of a property, use as little as retirement plan funds as you can. You can wholesale a property. You could just flip the contract effectively if you wanted with your retirement account. Again, you could lend. So, and you can make as much money as you can. I mean, my largest client has a 300 million Roth IRA, I mean, and he did it in doing real estate primarily, but it's just getting really good deals. And so there's no cap on how big you can go. There's a cap on how much you can put in each year as a contribution.
As a new contribution.
Yeah.
New contribution.
$6,000 is a new contribution, 7,000 if you're 50 or older. And there's no cap on how much you want to convert. If you've got a, $500,000 401k and you want to convert the whole thing to Roth, you can do it. The IRS will send you a thank you note because you're gonna have to pay tax on $500,000 of income. But now you got this nice account that could really go and grow to turn into maybe a $2 million Roth IRA or a $5 million Roth IRA at the end of the day when you start pulling it out. So no cap really. I mean, again, Peter Thiel has the 6 billion Roth IRA.
God bless him. This is a good question, Tree. So yes. So the question, I have a self-directed IRA with a couple rental properties, but I still have a 401k from a former employer, which I've seen decline. So I'm assuming it was probably with like Fidelity or Vanguard and invested in stocks or mutual funds, right? Can I utilize the rule of 55 and take out funds and buy real estate? I may consider the Roth conversion as well that you've discussed. I'm 58 now, and I'm no longer working at my corporate job. So there's a lot of stuff going on in that question. So we can unpack that. But this is like a pretty common scenario because the majority of people's wealth is typically in their retirement account from their employer plan.
Yeah. And so Therese is already self-directing and already has a couple of rentals in her IRA. I think you are a great example of how you can contrast this and just get analytical. This is just me. I'm just like, when it comes to dollars and cents, I mean, it's math. And you have a good case study, Therese, of what you've already been able to do. Like I would, if I was you, I would just look at the rental properties you already have in your retirement account. What is the real rate of return you're getting there? Now I want to look at a couple of things. What's the cash flow you have? Do those have mortgages on them that you've been paying down? What's the mortgage pay down each year? What is the appreciation you've had in these properties? Okay. Now, if you run those numbers and you can get a good idea of, okay, here's what I've been able to do with the properties I've already done. Are there properties out there right now that I could get that could do similar? And then just compare it to what you've been able to do in your 401k and what you believe you'll be able to do in the future with the 401k. So just run the numbers, so to speak, and make a really analytical decision about it. Now, everyone has to make some assumptions here. We're predicting the future. I don't freaking know. Your financial advisor, if you have one, doesn't freaking know, right? They're just going to give you information and maybe recommendations. But where you can contrast your own account, Therese, between what you're already self-directing and real estate deals you have already done to what your 401k has already been invested into and what it's already done, just look at some of your track history of what you're doing and move money more. If you like, you know what, I've done better with the self-directing. I'm going to just keep doubling down on what's working and what I've been able to show I'm better at and start moving more money out of the 401k. But if it's a former employer 401k, you can be pulling all that out, of course. So
yeah, there is no that rule of 55 for the old employer plan that you're referencing there. So you're good to go. Okay, that was good. That was good. Should we hit this other investment type and then?
Sure, if you want to.
You want to do it? Well, I think it's good as an option.
Okay.
I'd rather hit this one.
Okay. Well, just two other types you can do. Let me just show those. We'll just hit them quick here. Let's go. Let me just share the screen and then we're wrapping up. Thanks, everyone. I know we're going a little bit over. We just love being with you,
Simple as that.
Yeah. Dang it.
Well, fortunately, you got the quickest mouse in the West.
Yeah, this mouse is trigger happy. All right. Okay. So you can buy crypto with your retirement account. We have the crypto IRA. Whether you think crypto is a bargain right now, I don't know. Again, this is
your call.
Yeah. So, but it's been a popular asset, of course. It's been the most popular alternative, quote unquote, new asset out there for the last, 5 to 10 years. We've seen it go up in the ups and downs, though. Even in 2017, when I first helped clients do it, and I shot my first video on how to buy crypto with an IRA, which it was Bitcoin was $2,500 back then, you know, and now it's, you know, I think it's still over 20 or so right now. It's gone up significantly, obviously, but you know, but it was also at 60. So you could have been like, yeah, but I bought it in 2021, Matt, at, you know, 50. So it's down now. So, but you can look at that. That's an option right now, of course, is buying crypto. It's a little bit newer thing on how to do it with an IRA. We've got a pretty easy product to do it with Gemini, who's, by the way, regulated, licensed trust company. Your funds are custodied. They don't have control of them. I mean, they do in terms of they're custodian of them. But like if they went bankrupt or something, these are custodial accounts. These are not their funds. They're your funds. So it's a little different than some of the other providers out there that have had some bankruptcy problems. There's a different type of operation. So we still feel comfortable with Gemini, but you don't have to use them. You could use an IRA LLC structure, which we have, and use whoever you want, frankly. But there's a lot of options there still with crypto on what you can do. Anything you want to add on that?
Just say like, if
Maybe
you're
our updated pricing too.
Yeah, so we do have updated pricing. It's just a low annual flat fee of $295 and then an all-inclusive 0.5%. So 50 basis points to trade with the crypto IRA with Gemini. I will say that if you've read the headlines, you've looked at some of the other companies, I'm not going to name them here, but you know, they had various lending programs where you could lend out or stake your crypto and receive a, you know, yield back from it. I'd be like, you know, I don't know if that's the greatest thing, but do your own due diligence. If you're comfortable with it, cool. You can read the headlines of what's happened. That program is available through with Gemini. Some people choose to do it, others don't, but it's, you know, it's fully disclosed on who they use, what's done with it. And so, you know, do your due diligence, just like anything, just like when you're analyzing a rental deal or looking to lend some of your funds out in a retirement account on a fix and flip, same rules apply for that. But it is the easy button. If you don't want to use Gemini, and you want to like hold the keys yourself or move completely off exchange, then do the IRA LLC structure and go get your own institutional account. Super easy.
Yep. Okay, last one.
Yep.
Precious metals. So
I like it.
Your retirement account can actually own physical precious metals. They're stored with a custodian. You know, we use Delaware Depository Trust Company, but you actually own the real precious metals that's sitting in a, you know, very secure place. It's licensed, regulated, insured, all that. But there's only certain metals that qualify: gold, silver, platinum, and palladium. Okay, those are the four precious metals you can buy. They each have their own purity requirements. It's another chapter in my book. We have a lot of their content on it, because there are certain precious metals that don't qualify, that a lot of dealers will sell, that don't really work in an IRA.
Those collectible.
Yeah.
Or, you know.
Yeah. And like, so be careful on that type of stuff. Other thing that's important to know on this, there's a recent case on this, you cannot store them at home. Okay. We've been saying this for years. It's in my book. I've written articles on it. We've never let clients do it. You cannot store your precious metals at home.
Or under your mattress.
Yeah. And so that client got their account distributed. It was a big case last year or early this year on the reason IRA LLC structure actually in storing at their home. But so no home storage. There's literally a code section. It's in section 408 of the tax code that says you cannot store them, or that says they must be stored with a custodian. It's either a bank, credit union, or trust company. So, but then you typically use a precious metals dealer. Just buyer beware out there. There are some dealers. Just shop around on pricing on it. We just, over the years, we just see a lot of variation. And so it's up to you on who you're going to use and the price you're going to pay and negotiate. We don't get involved in that. We process what you want.
Yep.
But just a little recommendation to do some due diligence on the precious metal dealer you're working with, and maybe check a couple other places on pricing of whatever
it's pretty straightforward though. It's like you can pull the spot pricing.
Yeah.
So you know what the comparison is, and you can do the numbers yourself. Like, okay, that dealer has a 20% premium. This one's got a 30% premium. Like you can run the math. So do your due diligence, find you a good deal. But
and all of them are going to have a markup.
Yeah.
Right? It's just how much, because they are a business. They sell this and make money doing it. So they can't sell it for spot price. So typically, so just you want to look into that. So, all right, these are all the resources. There's more info on this. These key points and more detail are on the website on these different asset classes. Yep. Some of these are ones you don't know about or want to learn more about. We've got more of that content. And then if you want to open a new account,
keep going.
Refer a friend over, maybe, use the webinar 50 promo code. save you $50 on your new account fees when you're
Mhm.
setting up. We're gonna be doing another webinar. I think we're gonna do it on short-term rentals actually in your retirement account. We might have a special guest. We'll be announcing that. But that'll be August 10th. Get over to directedira.com webinar where you can look that up. Make sure you're subscribed to the newsletter. That's the
Mhm.
easiest way. If you're not already, get subscribed to the newsletter and you'll get updates on upcoming webinars and other articles and contents we have coming out on retirement accounts and how to take control of it.
So, yep, directed IRA, that's the place to be. We get asked, to compare ourselves with other companies that offer retirement accounts. I'd say the biggest one is, we're a licensed and regulated trust company. Our license is with the Arizona Department of Insurance and Financial Institutions. So that's where ours is. There's some out there that are called third-party administrators that have to use a custodian such as us. So they're kind of a go-between. And but we're going to answer the phone. We're going to answer an email, and we want to help you out and be here. We're here 8 to 5, Monday through Friday, Arizona time, and want to answer the questions that you have to help you self-direct your retirement account. You're not going to just get some robot chat bot, or help for them. So we'll answer your call. So come and check us out. We'd love to hear from you. Love to support what you're doing, and we'll do the best we can. I think we did it.
Yeah, thanks everyone for being on. Thanks for the questions. Since you registered for this, if you're on, you're going to get an update on when the recording's posted. We appreciate all the questions. We'll be back, of course, next month with another Directed IRA webinar. Make sure you're also following the podcast too, directedira.com/podcast, where you can follow the podcast, which also goes on my YouTube, Mat Sorensen, and goes out on all the different podcast channels. But until the next Directed IRA webinar, stay calm, self-direct on.
And Roth and roll.
And Roth and roll too.